What's up, you guys? Welcome back to the channel. So in today's video, I'm going to show you guys an option strategy that you guys can implement, especially if you have a smaller account. Now, I consider a small account anything under about $10,000, but you can really use this strategy all the way down to $1,000 and possibly even less if you choose a cheaper stock than I have here. And this strategy that we're going over is called the poor man's covered call. Now, I don't want you guys to have a misconception about this strategy and think it's for poor people just because the word poor is in the name. Many people actually use this strategy, myself included, and you can really make great money without having to put up nearly as much capital as buying shares. But before we actually get into how this strategy works and really how much money you guys can make, if you guys are new here, my name is Evan and I make videos that show you guys different ways of making money in the stock market. So if that interests you guys, make sure you subscribe and hit the notification bell so you never miss when I upload. Also, if you guys enjoy these types of videos, make sure you guys go down and hit the like button because I really appreciate it. And it lets me know that you guys enjoy these videos every day. So again, if you guys wouldn't mind hitting the like button, I would really appreciate it. Now, to jump into how this strategy works, we basically want to find a stock that we have a long-term bullish mindset on. Now, right here, I've chosen Plug Power. And this isn't saying that I'm personally bullish on Plug. I'm just using this as an example. So I don't want you guys to copy this exact trade because this is just for example purposes. And it's just to show you guys how this strategy actually works. So again, we want to choose a stock that we have a long-term bullish mindset on, but also a stock that we think may go down in the near future in the next 1 to 2 months. They could either go down or trade sideways for that period. And that's where we would get the most benefit from this trading strategy. So of course, we want to go to the options here for Plug Power. And now the first leg of this option that we're going to be buying is we want to buy a leaps option. Now, if you guys aren't familiar with leaps, I'm going to put a video up here in the top corner. And that explains how leaps work. And it goes pretty in depth, especially for those of you who have never heard of leaps or you're not familiar with how they work. Now, I'll give you a quick rundown, but I really suggest that you guys go watch that video first and then come back here so you know exactly how they work. But first, we're going to be buying a call that expires at least 6 months in the future and preferably at least 1 year. So we're going to go up here to the expiration dates and we want to choose one that's pretty far out in the future. Like I said, at least 1 year preferably. So if we scroll down here to the bottom, the two farthest dates are January of 2022 and 2023. Now, January 2022 is really only about 6 months away. So you could do that if you wanted to, or if you had a lower capital to start with, but we're going to choose the January 2023. So that's about 1.5 years away. So the first part of this is buying the leaps option. And this is going to be a call that has a delta of about 0.7 and is expiring about 1 year or more in the future. So this first one right away here at the $27 strike price, it costs $10.33 per contract. And it has a delta of about 0.7. So we're going to use this as our example, and this is going to be the leaps option that you're going to be buying. Now, how leaps work is basically every dollar that the share price moves, the premium that we paid to open this is going to move by that amount times 100. So our delta here is 0.69. So every dollar that Plug goes up, we're going to be bringing in $69. Now, it also works the opposite. If Plug drops by $1, we're going to be losing $69. So now that we've opened the leaps option, we want to be selling a call against this. Buying this leaps option is almost simulating owning 100 shares because, as you guys know, in order to sell a call and open a covered call, you actually need 100 shares of the underlying stock. So by buying this in the money option that's really far out in expiration, we're somewhat simulating owning 100 shares. And in return, we can sell calls against that to collect premium and bring down our average cost, which in turn is going to lead to more profits. So now that we bought this call here for $10.35, we're going to find an expiration date that's between 30 to 45 days out from the current date. So we got to scroll back up, and the current date is July 12th. So we want to find one that's 30 to 45 days out, and we could choose either this August 13th or the August 20th one here. Now you can choose farther out, but theta is really going to ramp up, and that's time decay, which we want when we're selling a call. So I'm going to choose this August 13th here. And now what we want to do is we want to sell a call here, and we want to sell at a strike price that we think Plug can't hit by the expiration date. And that's when we're going to collect our maximum premium. And you also want to choose a strike price that has a delta of about 0.3. Now that is kind of personal opinion, but that's typically what I look for when I'm selling a call against my leaps option. So if we start off with this $34 strike price, you can see here the delta is almost at 0.3, and I think this is going to work out great. So what we do is we just sell this call and we're going to collect $117 as long as the share price of Plug is below $34 at expiration. So this is a strategy that you guys can implement, especially if you have a smaller account and you believe in the underlying stock long term. Maybe you think short term the stock is going to trade flat or possibly even down, and that's when you can collect premiums against your long-term leaps option. And you don't necessarily have to open both of these positions at one time. You can buy the long-term leaps call, and then every 2 to 3 weeks or so, you can be selling these calls. And the reason I say 2 to 3 weeks is because that's probably about when you're going to collect about half of the premium. And once you collect about 50% of the premium, so of this $117, say you collect about $60, and that would be from the share price dropping about $2 or from theta decaying away at this premium. So if Plug dropped from $29 and they dropped down to $27, because your delta is 0.3 about, you're going to be earning $30 every dollar that this drops. Now your long-term option is going to be losing more than that, so you're going to be down in the short term, but then once the price of Plug recovers, and say they go back up to $29 from being down to $27, you're going to have an additional $60 from this $34 strike price and collecting $117, because say you closed it out and earned $60, once Plug recovers, that $60 that you earned is just additional money that you wouldn't have earned otherwise unless you sold this call against your long-term leaps. Now there are a couple situations where you wouldn't want to be selling a call against your long-term leaps option, and one of the biggest reasons would be if you're expecting Plug or whatever underlying stock you're using, if you expect them to go up in the short term, and if you expect that to be a large upward movement, you're just going to be hindering your potential growth because your long-term leaps option, this $27 call expiring in a year and a half, that's going to have a delta of about 0.7. So for every dollar that Plug goes up, you're earning $70. But if you sell this $34 strike call against your long-term leaps, well, every dollar that the price goes up, you're losing $30 on this option. So you're really only making $40. Now you're still making money as the price goes up, but you're hindering what you possibly could be making because you sold this call against it. So this is more of a strategy if you think that the price of the underlying stock is going to trade flat, because if they trade flat, you're going to be earning money from theta decay, because in this example, you'd be earning almost $4 every day just by holding this option. And then the other situation is if you think the price is going to go down in the short term and end up recovering so that you can make money on the long-term call or the leaps that you bought as well. So you can make money in the short term if the stock price goes down, and then you'll make more money as the price goes up in the long term. And that's really the beauty of this strategy, because just with $1,000 here, by opening this long-term call at 10.45 and paying $1,045, every month you can sell a call against that and earn $118. And say, for example, you had a $5,000 account and you ended up buying 5 of these $27 strike calls. Well, you could sell 5 calls at this $34 strike and earn $550 or so. So this is a really powerful strategy under 2 conditions, and that's if the stock trades flat in the short term or trades down. And again, make sure you guys aren't selling a call if you expect the underlying stock to go up in the short term. If you expect that, just buy the long-term leaps option and don't bother selling the call, because then you're just hindering your potential growth and you're losing out on potential profits that you would have made without selling the call. Now, one other thing I want to go over is how expiration works and what's going to happen depending on the share price of the underlying stock at expiration. So in this situation, we have Plug Power. If their share price goes from $29 and they get anywhere close to $34 by August 13th here, Robinhood, which has happened to me before and it's happened to many people, they're going to close out this position and close out both legs of this option just to protect you. And if they don't end up doing that and say the share price goes above $34, well, you're probably going to get exercised on this covered call. And then Robinhood or whatever trading brokerage you're using, they're going to use your long-term $27 call in order to pay for the shares that you're owing on this covered call. So again, just to kind of review, if the share price is getting close to $34 or whatever strike price you sold at, you're going to potentially be at risk of both positions being closed out. So just keep that in mind when you're trading. But as long as the share price stays pretty far away, I think you should be good. And then you would be collecting the maximum premium here, which in this case is $115 in about 1 month. But most of the time, like I mentioned earlier, you don't want to be holding this all the way to expiration. Typically, you want to be closing this out when you collect about 50% of the max premium, because once you hit about 50%, it's going to be harder and harder to get that last 50%. And again, once you hit 50%, then you can just roll out and sell another covered call against your long-term leaps and extend that out another month. And you'll be resetting yourself to where the theta really starts ramping up at that 30 to 45 days. And there's also too much risk when you've secured about 50% early on. You don't want to lose the 50% of the premium that you already have gained. So I think this is a great strategy if you guys are new to options, or you're more of a long-term trader and you don't want to be buying stocks every day. This is a strategy you can really take advantage of, and a lot of smaller accounts can take advantage of this as well. And you don't need as much capital as buying 100 shares of the company, yet you get to simulate owning 100 shares, and you can sell covered calls against that long-term leaps, which typically cost half of what it would cost or less than buying 100 shares of the underlying stock. But if you guys have any questions about anything that we went over today, let me know down in the comments and I'll do my best to answer any questions you have. Also, if you guys enjoyed the video, make sure you leave a like because it really does help out the channel. And make sure you guys sign up for Webull using the link in the description, because when you sign up and deposit $100, you'll actually get 2 free stocks. So make sure you guys sign up while this offer is still available. And with that said, thank you guys so much for watching, and I'll see you back here in the next one. Bye.